In my career as an operational risk manager, my job was to identify the single point of failure that can take down an entire system. I looked for that one crack in the foundation that could cause a total collapse. Right now, I see that same crack forming for many investors. There are two financial worlds operating side by side. If you mistake one for the other, you're creating a single point of failure that'll destroy your retirement plans. Today, I'm going to show you how to spot these traps before they cost you everything. And I'm being very direct here because the stakes are high. Your financial health depends on understanding that real wealth is built on economic productivity, while investor traps are built on hype. To see how these traps work in the real world, we don't have to look too far. A recent article in Seeking Alpha highlighted a perfect example of this two worlds phenomenon, and I will leave a link in the description. It detailed how a new generation of digital asset ventures is generating billions in months, not years, by leveraging political proximity and massive public hype. I'm bringing this up not to talk about politics, but to analyze the structural risk. When you see this kind of rapid wealth creation, you have to ask yourself, is this an engine of productivity I can hitch my wagon to, or is it a wealth-depleting trap designed for someone else's benefit? My point is that one financial world belongs to the connected and the politically proximate. The other belongs to everyone else. So the first investor trap is hype. When you see a famous name or a political figure attached to a crypto token or a private deal, it feels like an invitation. You think you're being invited into the inner circle. But you aren't a partner, you are the liquidity that's funding their fortune. Before you put $1 into any venture, I recommend that you run it through this safety engineering checklist. First, the source of value. Does this asset create a product or service people need? In other words, a productive asset. Or does it rely on more people buying in later? Hype. Transparency. Are the financial disclosures audited and public, or are there quiet deals and opaque structures behind the scenes? The exit strategy. Is this a buy and hold asset for long-term growth, or is the asset dependent on a sudden price spike? Risk symmetry. If this fails, do the founders lose as much as the retail investors? Or are you the only one standing on the trap door? If this time feels a little like deja vu, it's because we've been here before. In the 1920s, America lived through an era of extreme wealth and illusion, the world of the Great Gatsby. In the book, there is a divide between the established wealth and the wealth created from hype and speculation. Today, the divide is again between the calculated wealth and the hype wealth. And that original party ended in a total collapse. The only people who survived were those who already held power. The ordinary people who tried to play the Gatsby game, those were the ones who lost everything. So in the elite financial world, power and money reinforce each other. When you're connected, speculation is optional. Losses are survivable. Risk is asymmetric, meaning it's the little guy who's the one that gets crushed. If their crypto venture fails, it's a tax write-off. If it succeeds, the upside's gravy. But in your world, in my world, the middle-class reality is that mistakes compound negatively. From a risk management perspective, this is a single point of failure. For an elite family, a speculative side bet is a tiny node in a massive network. For everyone else, treating a speculative token like a core investment creates a vulnerability. If that token drops 80%, your safety margin for retirement evaporates. Take a recent news story about the political figures in crypto. While the public was being told that these tokens were the future of finance, the founders were moving $1.4 billion into their own accounts. And this isn't a moral argument, it's a structural one. The wealth was created by the act of selling the token, not by the token actually producing anything of value in the economy. If you bought in, you weren't investing in a business, you were participating in a wealth transfer. The second trap I want to talk about is political bias. Over the long run, the stock market goes up based on economic factors, not political opinions, wars, or world events. It is financially disastrous to apply political bias to your investing. My goal here is to manage risk, not debate politics. In my view, politics is just a sideshow. Don't base your financial decisions on who is currently president or what party is in power. Let me give you an example. Let's look at last spring, 2025. The market crashed nearly 20% in 7 weeks. What some called Liberation Day because of sudden changes in tariff policy. People were terrified, but guess what happened? The market went back to focusing on company earnings. The companies were still productive, and the market recovered and ultimately hit all-time highs. The people who got scared out of the market by political headlines lost out on a massive rally. To recap, there are 2 main traps we need to be aware of and avoid: the hype trap and the politics trap. And they're related because they both rely on emotion rather than data. The hype assets live in the financial world of the politically connected. It's a world that the rest of us must avoid. Instead, our goal should be to build financial security with productive assets, companies that make things or provide services that people actually buy. Real diversification is by investing among productive assets, not owning different types of crypto, for example. And boring consistency, assets that grow because of human innovation, not political or hyped headlines. So we take our cue from the economy, not from any one political party. Politics change, narratives swing, and elections come and go. But the long-term engine of growth favors productivity. If your plan feels boring, it's probably working. On the other hand, if you feel pressure to chase a shortcut, be aware that those are the traps of hype and politics trying to pull you into a game none of us were meant to win. Stay grounded, stay with productive assets. That is how the mindset of wealth actually works. So what are your thoughts on this topic? Feel free to share them in the comments section. If you found this video helpful, please give it a like and consider subscribing. It helps this channel grow and reach others who can also benefit from these ideas. Thank you so much for watching.